This video is for educational purposes only, not financial advice. Always consult a certified financial advisor before investing. We are not affiliated with Vanguard or any ETF provider. What if your investment paid you every single month like a salary? Imagine opening your brokerage account and seeing cash deposits arrive month after month without selling a single share. That is exactly why thousands of investors in 2026 are paying close attention to JEPI. Welcome to ETF Holdings USA, the only channel that breaks down every holding inside America's top ETFs. Today we are talking about one of the most popular income ETFs in America right now. The full name is JPMorgan Equity Premium Income ETF, and this fund has exploded in popularity because of its high monthly income strategy. We will cover what JEPI is, who manages it, all holdings beyond the top 10, how the covered call strategy works, the monthly dividend explained, dividend yield, expense ratio, JEPI versus SCHD comparison, who should invest, future outlook 2026, and whether beginners should invest. Let us get started. In simple words, JEPI is an income-focused ETF designed to give investors monthly cash flow while also providing exposure to large U.S. companies. Instead of focusing only on fast-growth stocks, this ETF combines stable dividend-paying companies with a covered call option strategy to generate additional income. That combination is what allows JEPI to produce a dividend yield of 8.93% in 2026 while paying dividends every single month. As of May 2026, JEPI has a price of $56.50 per share and manages over $44 billion in assets. That monthly payout is the main reason many retirees, passive income investors, and conservative investors love this ETF. JEPI is managed by JPMorgan Asset Management, which is one of the largest and most respected financial institutions in the world with trillions of dollars under management. The ETF launched on May 20th, 2020, and since then investors looking for passive income have been watching it very closely. When investors buy JEPI, they are trusting experienced portfolio managers who actively select stocks and manage option strategies to reduce volatility and generate income. Unlike many passive ETFs, JEPI is actively managed, which means professionals are constantly adjusting the portfolio based on market conditions. JEPI currently holds 121 U.S. stocks across many sectors, including technology, healthcare, financials, industrials, consumer products, and energy. Now let us talk about all the holdings inside JEPI beyond just the top 10. Most channels only mention the biggest names, but here at ETF Holdings USA we go beyond the top 10. The top 10 holdings make up only 17% of the entire fund, which means the other 83% is spread across 111 additional companies. Some of the major companies often found inside JEPI include large blue-chip names like Microsoft, Amazon, Meta Platforms, NVIDIA, MasterCard, Visa, United Health Group, PepsiCo, AbbVie, and the Coca-Cola Company. Beyond those top names, JEPI also holds companies in banking and insurance like JPMorgan Chase, Bank of America, and Progressive Corporation. In the healthcare sector, JEPI holds companies like Johnson & Johnson, Bristol Myers Squibb, Merck, and Pfizer. In the technology sector, JEPI holds companies like Accenture, Automatic Data Processing, and Fiserv. In the energy sector, JEPI holds companies like Chevron and ConocoPhillips. In the consumer sector, JEPI holds companies like Procter & Gamble, Walmart, and Costco. In the industrial and defense sectors, JEPI holds companies like Lockheed Martin, Honeywell, and Caterpillar. This broad diversification across 121 companies and multiple sectors helps reduce risk because the fund is not depending on only one company or one industry. Now here is the most important part of JEPI and the reason its dividend yield is so high at 8.93% in 2026. The covered call strategy. Many beginners hear this term and get confused, but the idea is actually very simple. Imagine you own shares of a company. Normally you only make money if the stock price rises or if the company pays dividends. But with covered calls, JEPI can generate extra income by selling options contracts to other investors. Those investors pay premiums to JEPI for the right to potentially buy shares at a certain price later. Think of it like renting out your stocks to collect extra cash every month. Even if the market moves sideways, JEPI can still earn income from those option premiums. That extra cash is one major reason the ETF can pay such high monthly dividends. The trade-off is that covered call strategies can limit some upside during powerful bull markets. So if the stock market suddenly explodes higher, JEPI may not rise as fast as growth-focused ETFs because some gains are limited by the options strategy. But during volatile or slower markets, JEPI often looks much more attractive because of its consistent monthly cash flow. Speaking of dividends, this is where JEPI gets massive attention. Unlike most ETFs that pay quarterly dividends, JEPI pays investors every single month. That means 12 payouts every year. The most recent dividend payment was made on May 5, 2026. JEPI has paid $4.73 per share over the past year. For many people, this monthly payment feels more like receiving a paycheck. Investors often use these monthly payments for retirement expenses, rent, groceries, bills, or reinvesting into more shares. The current dividend yield is 8.93% in May 2026, although it can change depending on market volatility and option premiums. Higher volatility often means higher option income, which can increase payouts. Lower volatility can reduce payouts. So the monthly amount is not fixed, but the income focus remains the core strategy of this ETF. Now let us talk about fees. JEPI has an expense ratio of 0.35%. That means for every $10,000 invested, around $35 annually goes toward management costs. Some investors may think that is higher than index ETFs like VO or SCHD, but many income investors believe the active management and options strategy justify the higher fee. Compared to traditional covered call funds, JEPI is still considered reasonably priced by many analysts in 2026. Now the big comparison in 2026 is JEPI versus SCHD, because both are extremely popular income ETFs. SCHD focuses more on high-quality dividend growth companies and usually has a lower yield than JEPI. SCHD also tends to have stronger long-term capital appreciation because it does not use a covered call strategy that limits upside. On the other hand, JEPI provides significantly higher monthly income and usually experiences lower volatility during difficult markets. So SCHD is often viewed as a better long-term growth and dividend growth ETF, while JEPI is often viewed as an income machine built purely for monthly cash flow. Many investors actually own both together to balance growth and income in one portfolio. So who should invest in JEPI? This ETF may be most attractive for retirees looking for monthly income, passive income investors, people seeking lower volatility, and investors who want consistent cash flow without selling shares regularly. It may also appeal to investors who feel nervous about market swings and want a smoother investing experience compared to aggressive growth funds. But younger investors focused entirely on maximum long-term growth may prefer ETFs like VO or VTI because those funds can potentially grow faster over decades without the limitations of a covered call strategy. Looking ahead in 2026, many analysts believe JEPI could remain one of the top income ETFs in America, especially if market volatility continues. Interest rates, economic uncertainty, and slower market growth may actually help covered call strategies remain relevant and attractive. More investors today are searching for reliable passive income instead of depending only on stock price appreciation. That trend could continue pushing demand higher for income-focused funds like JEPI. But investors should still understand that no ETF is perfect. If the market enters a massive bull run, growth-focused funds may outperform JEPI because covered calls can limit upside potential significantly. So should beginners invest in JEPI? The answer depends entirely on their goals. If a beginner wants monthly income, lower volatility, and exposure to large U.S. companies, then JEPI can be a simple and very attractive option in 2026. But if a beginner is young and investing for maximum long-term growth, they may want to combine JEPI with growth-focused ETFs instead of relying on income alone. The good news is that JEPI is relatively easy to understand compared to many complicated option strategies because the ETF managers handle the entire covered call process for investors automatically. That simplicity, combined with the current yield of 8.93% and 121 diversified holdings, is one major reason the fund has become so incredibly popular in 2026. At the end of the day, JEPI is not about getting rich overnight. It is about building steady monthly cash flow from a diversified portfolio of 121 American companies using a proven income-focused strategy. And for many investors in 2026, that monthly paycheck-style investing approach feels very attractive. So here is the question for you. Would you rather invest for monthly income with JEPI or maximum growth with VIO or QQQ? Tell us in the comments below. If you enjoyed this breakdown, hit like and subscribe to ETF Holdings USA for more ETF videos every single day. New breakdown uploaded daily. Thanks for watching. This video is for educational purposes only, not financial advice.